Kia ora. Nā mihi nui kia koutou e na raurangatira mā, nau mai, haere mai, whakatau mai, ki tēnei hui mariko. Ko Barry Kurtsaho, ko te kaurahi o te putea whaiwhakaro. Nā reira, tēnā koutou, tēnā tātou katoa, tihe Māori ora. So a very warm welcome to you all. I'm Barry Coates. I'm CEO of Mindful Money. We're a charity that aims to make money a force for good. So as well as providing radical transparency for KiwiSaver and investment funds, we undertake these seminars to educate the public and highlight how investment can make a difference on issues that really matter. This is actually the 18th seminar in this series, so who's counting? See our website for recordings on climate change, net zero, social housing, impact investing, investment in Russia, nuclear weapons, animal welfare, green property, ethical investment standards, and last week, Te Ao Māori perspectives on investment. But tonight, we're going to be talking about the role of investment in tackling climate emissions. And without further ado, I'm going to go straight into introducing the first of our panelists. So I'd like to extend a very warm welcome to Matthew Arnold. So Matt is responsible for leading the New Zealand and South Pacific business for Russell Investments, which is a global investment solutions provider. The local Russell team delivers a range of services that assist investors in meeting their goals, including investment consulting, outsourced chief investment officers, and global multi-asset investing. So Russell's been operating in New Zealand for over 30 years and works with investors of all shapes and sizes across all stages of the investment process. And prior to joining Russell, in 2019, Matt worked at a number of global asset managers in the UK, US, and Singapore. So, Matt, very warm welcome to you.
Nice to see you, Barry. Thanks for having us on this evening.
Cool, great. Matt, can you give us a snapshot of some of Russell's work around climate emissions and the kind of things that you're involved in?
Yeah, absolutely. So, I guess it's worthwhile to think of or sort of define what we mean by climate risk in an investment context. So, it mainly, means how your investments can be impacted by climate, particularly as we move to a lower carbon economy. If we look at companies, they can be impacted in that transition period. So what's known as transition risk. Think of a car manufacturer who has a diesel sort of car that they manufacture that gets banned. People don't want to use it, etc. That's an example of transition risk. Physical risk. As an example, we might have cyclones or extreme weather events and so on. So sort of identifying the risks out there and then also the opportunities available too. That's a key part of thinking about climate risk and investments.
So what a lot of people may recognize are things like stranded asset risks, where infrastructure is used for making fossil fuels, oil and gas production, for example, is no longer valuable. The reserves are no longer valuable as oil and gas is phased out in favor of clean energy. You classify that as part of the transition risk, presumably.
Absolutely. Yeah.
And presumably that's one of the major sources of risk. Do you have a sense of what's kind of significant and material in terms of those risk factors?
So when we look at the sort of carbon risk of companies globally, we do see a lot of that carbon risk and fossil fuel risk tied to a small section of the economy. So fossil
Mm.
fuel companies, naturally, but also utilities and so on, do carry a lot of the carbon emissions, but also the fossil fuels on their books. So without a doubt, that sector of the economy does represent a lot of the risk within a global context.
Good. And just finally, the obviously these risks are coming to the fore in terms of reporting with the new legislation on climate disclosure. Can you describe a little bit what difference that will make to companies and investment funds that are going to have to report under this new legislation?
Yeah, well, the old saying, you can't manage what you don't measure. So once, if you look at companies, they realize that this is important to investors. So around the world, they are paying more attention and getting more focused on releasing this information to the investor base. And investors themselves are obviously taking that more seriously and analyzing it and so on. So later on with Craig, we'll be talking about investment solutions and what investors can do to sort of participate in the climate transition. But just having that information is a very important part of the process.
Great, good. We'll come back to that. So thanks, Matt. I would now like to extend a warm welcome to our second panelist. It's Craig Weise. Craig leads New Zealand Green Investment Finance, often known as New Zealand GIF or GIF. And it's a Crown-backed green investment bank. It has the purpose of accelerating low emissions investment in New Zealand. NZ GIF's investment approach, flexible mandate and long-term horizon help it to unlock and create investment opportunities, drive impact, and provide access for others to climate-friendly investments. So they're leveraging in private sector investments as well as the impact of their own investments. Craig has spent his career immersed in different aspects of capital markets, both in the US and New Zealand, across a number of professional and executive roles. He's now focused on demonstrating how powerful capital can be when it's coupled with purpose. So a warm welcome, Craig.
Kia ora, Barry, and good to be here. Thank you.
Great. Craig, I've caught up over the last year with some of the investments that you've been making. Can you give us a snapshot of where the investment portfolio is up to and how NZ GIF is doing these days?
Absolutely. So we're pleased actually to announce an investment today, which I'll talk about in a moment. But we've been pretty active in those parts of the market where we see scale being achievable. So we can go and use our balance sheet to make a difference and scale something that eventually will become available to other investors as well. And so we've done a lot to date in distributed energy, particularly solar and transport. And we've made further investments in agriculture and some technology plays as well. The investment I mentioned today that was announced was once again in transport. So coupling ourselves with a major international company called Zenobē, who manufactures buses and making those available through a leasing model here in New Zealand, with GoBus being one of the first customers. So that's today's transaction, if you will.
So on today's transaction, presumably the lower capital costs for a leasing model will be significant for some public sector agencies who maybe don't have the authorization for capital purchases. Eh?
Well, that's right. Taking advantage of, if you will, the OPEX savings that electric vehicles provide and smoothing that curve over time, so it works from an economic basis and provides, of course, the carbon benefits at the same time.
Fantastic. And Craig, this was sort of initially capitalized at $100 million, and then you were lucky enough to have the government give you a vote of confidence and give you another $300 million. So Is that adequate for you to play this role? Are you still looking for greater capitalization, or is this about right for the meantime?
Yeah, no, great question. Thanks, Barry. I think the climate challenge for New Zealand is great, and certainly we have found in our work to date and continue to see opportunity for greater deployment of capital. And I think one of our key purposes is to crowd in more private capital. So the Crown's decision to invest and support us with capital is only one way that we can do that. And so you'll be seeing more from us in that regard, in particular this year, where we've got a financial product in the work that will be available for institutional investors. And so, being able to do that is not only about building our balance sheet and deploying more capital into climate, but it's also about fulfilling the other purpose, which is, leveraging public money with private capital.
Great, yeah, and we can come back to this, but there are some good international models that you're following as well, I understand.
That's right. The Green Bank model has been fairly tried and true, with a growing number of countries or jurisdictions adopting it, and we've generally followed that in its formulation, if you will, with some nuances that have been required because of the size and nature of the New Zealand market.
Yeah. So let's form the panel. So welcome back, Matt. And we had a quick conversation amongst the three of us about issues that we're going to discuss, but we're also looking forward to questions from our audience tonight. So those of you on Facebook, feel free to ask your questions, and my colleague Olive will bring them through to this Crowdcast platform. And on Crowdcast, there's a button that says Ask a Question. So feel free to use that liberally and pepper us with questions left, right, and centre. And in the meantime, I'm going to kick off with a few issues myself. Matt, I want you to set the scene on how to manage emissions reduction if you're a funds manager. And my simplistic view of life is that you can kind of exclude some companies that have really high emissions, and you probably shouldn't be invested in anyway. Some of the fossil fuel companies, some of the thermal coal power generation, etc. Then you've got a bucket that is engagement, where you can influence companies to do the right thing to reduce their emissions. And then thirdly, you've got the area that Craig is more involved in, where you're really looking for climate solutions and how to catalyze change. Do you see those three areas being kind of equally represented through portfolio management? Traditionally, I guess divestment and getting out of fossil fuels has been the sort of popular solution and the first port of call. But it seems now that more and more funds are arguing that engagement is a more effective strategy. What's your view on that?
Yeah, well, I think most institutional investors and fund managers as well actually go on a bit of a journey when it comes to climate. So it is to look at the issue and kind of get your hands around what it is that's important. The first stage, as I mentioned earlier, tends to be managing or sort of measuring. And the first thing that people tend to do once they have measured is to exclude the very high emitting companies from their portfolios. So that's sort of step one. Step two is to try and be more proactive and have a positive slant on things, and absolutely engaging with companies so that they can do better in the future. Is a key part of the sort of low carbon investment strategy today. Then the final area, and I'd say this is towards the end of the journey, is when you really want to be proactive and make a real positive impact. And so, in our investor base globally, those types of investors would look to allocate capital to climate transition funds, for instance, in the PE space. So you asked about the scaling of this. I think exclusions are a significant part of the landscape. If we look at New Zealand with the default reviews and so on, you see that in most KiwiSavers. Most fund managers now are engaging with their investments, however, so that's pretty popular. And on the actual proactive impact side, less opportunities for investors, but that is certainly changing.
Yeah, and really for you, Craig, are you seeing increasing interest from mainstream fund management in that area that Matt was talking about, into the climate solutions, where those are the people who you may be co-funding with?
I think yes and no. I think we're seeing we're hearing a lot of conversation about it from the mainstream. And I think one of the challenges that climate solutions investment faces is that it primarily is around the provision of new capital. And so, secondary markets, which, dominate the dialogue and dominate the money under management, don't tend to provide that directly into climate solutions now. And that's exacerbated by the construct of the New Zealand market around where those assets are owned and how we operate. So, a fund manager, I think, has to be comfortable in, owning, if they really want to have climate solutions investments today that are readily available, of owning less liquid investments is the reality. And eventually, over time, those will become available, in the listed markets in which they participate. But there's a big time gap in between, and obviously time is not our friend with respect to climate. So we would argue that this is actually a fundamental conversation for us in the industry around how we feel about that.
Yes, that's a key issue. So just to kind of draw this out for the audience, as you said, if you invest in the secondary market, i.e. in a company that has shares and you're buying some shares, then you're not injecting new capital in the same way that you are typically in venture capital or private equity, or supporting smaller companies to grow. Matt, to you described this climate solutions being more at the end of the process and further down the line. Is that because of concerns about issues like liquidity and the fact that it's hard for the mainstream fund managers to invest in unlisted vehicles?
I think that's a fair comment. I mentioned that it's a spectrum from sort of exclusions all the way up to proactive investing. And as you go along that spectrum, it does get more challenging. So you need access to funds, you need a greater skill set, and in some cases, you need the ability to tolerate being locked up for a while. I think, as Craig mentioned, and as a lot of folks in the private assets market in New Zealand have mentioned, something like KiwiSaver, which has a long-term goal, meeting retirement requirements for investors, that should be a pool of capital that can invest in these longer-term thematics. So I guess it's incumbent on the industry to develop products that work for KiwiSaver investors.
But I guess, Matt, the starting point at this point in time is relatively few funds do that investment in climate solutions at the moment. Where do you think the barriers are? Is it, as you described, the lack of investable fund propositions? Do they need institutions like NZ Gift to maybe de-risk those investments, give them an easier pathway to invest? Where are some of those barriers?
Well, I do think a lot of investors have just started on this journey. So when we're working with institutional investors, we'll often say, as a board of trustees, set some investment beliefs as it relates to responsible investment, number one, but also climate. So to get those key beliefs down, and then to measure the carbon emissions of your portfolio, and then do something about it. So there's a lot of steps to take, I think, before many investors will feel ready to invest in private equity solutions that are targeting the climate transition. I mean, there's no doubt people have started on this path, though. Um, and if I think about the situation 2 or 3 years ago versus today, very, very different.
What's your perspective on those barriers, Craig?
Yeah, no, I certainly feel that that's everything Matt said is correct. I also would say that, we have particular market attributes here that complicate the situation for climate. A lot of, if you think about the various climate solutions that are out there, some of them are very, small things that need to be aggregated. Some of them are very big projects that require, say, project finance and project finance type equity. And a lot of them are kind of locked into asset bases that are controlled by local or central government. And so you take those attributes coupled with, a capital market that is very dependent on funding from our banks. So, we're one of the nations in the developed world where a huge portion of our money does come from the banking sector for new money. And it does get hard, I think, for fund managers in particular to actually access those. So how do we create those investable climate assets in a form that they are accessible to investors? And so that's something that we think very much about. But the barriers are real. There's no doubt about that. They're particularly real if you don't have a mandate that allows you to play in that part of the market.
Yeah, I wanted to pick up on that issue of mandates, because often if you're a fund manager, you're getting a mandate from the people who own the money. So the asset owners, which if it's an institutional investor, might be trusts and foundations, or it might be superannuation funds. It might be, in the case of the Crown, financial institutions, and New Zealand Super Fund, etc. Do you think there's opportunities for those asset owners to be more directive around the fund managers stepping up to this climate challenge? And one of the reasons I ask is at the end of last year, around the climate summit, COP26, where you were obviously, Craig, we did a survey of asset owners and fund managers, and some of the fund managers and asset owners had pledged to net zero, including Russell Investments, but actually not many had, and the reluctance to engage seemed to be higher with the asset owners. Is that your experience, Matt? Because you have a lot to do with the asset owners through consulting and providing services to them.
Yeah, I actually think the New Zealand CFIs have been very proactive on this front. So, they've banded together and made a collective statement and identified a direction of travel. So I think they've been very proactive, as have some KiwiSavers as well. I mean, if we look at the global universe of our clients, I think we would sort of say European investors and continental European investors are kind of ahead of the game or leading a lot of the development. But New Zealand investors and the CFIs in particular have been pretty proactive and are making some real positive steps.
Yeah, I realised the CFIs also made those net zero commitment. I was really thinking more about other asset owners, for example, the trusts and foundations, or your other pools of capital across the economy.
Yeah, I mean, so it has got increasingly important for those types of investors as well. The first steps, though, for them, it's more about sort of trying to understand the issue, see what they can do in their portfolio, and in many cases, it might just be a global equity portfolio that tilts away from the worst emitters, and tilts towards the lower carbon emitters. So that is a first step, and we're certainly seeing interest from community trust, foundation, endowments on taking that first step from an investment perspective.
And for you, Craig, where are your natural partners in the private sector for partnering and co-funding? What kind of institutions are you seeing expressing interest in coming forward?
Well, we have a really unusual mandate. So our flexibility and our ability to operate across the capital structure and across the economy is very empowering. To be quite honest, it's necessary to do our job over the next 30 years to help decarbonize. But it also means that, in some sectors, we may be doing something where, say, the banking sector is more important for us because it's about our role as a sub-debt provider and them coming as a senior lender, whereas in others we're dealing with where there may not be solutions, we're actually dealing with founders and venture capitalists. So there's no single answer to that, Barry. I think what we've found to date is that, on the equity side of our portfolio, and we're roughly 80-20, just to put that in context. And we, generally speaking, are looking to put equity where we don't see a solution in the near term, and our money is needed to develop that for the future. So there, we've had a lot of founders, small innovative companies, and other kind of participants who are looking at early stage equity on board. And then I think for things that we're looking to scale, we think about co-investment over time. So it's not necessarily the dollar that's there today for us, it's the one that's going to be there in 6 to 12 months, because we do our role to, quite frankly, get those transactions to a scale where they're ready for other investors who have features and attributes that they need.
Are you seeing, both of you, the potential for attracting overseas capital into New Zealand for emissions reductions and for climate-related investment? Obviously, we're a very small player internationally in terms of our capital markets, but I was struck by, for example, BlackRock's ESG fund investing in Meridian and sending Meridian's price way up, that a very small amount of international capital has a very big impact in New Zealand. Is there something about New Zealand's kind of climate profile that might attract international capital? Matt?
Yeah, I mean, you make a good point, and that was sort of 12 to 18 months ago now on Meridian, one of BlackRock's clean tech ETFs. But there's no doubt the energy sector or the generation sector in New Zealand is pretty green by global standards. So you can see that would attract capital. Craig's probably closer to the more up and coming sort of companies and areas in the market that could get sort of private capital as well. So it'd be interesting to hear from Craig on that.
Yeah, I think, I have to talk a lot on the global green banking scene, if you will, about where we are. And I think New Zealand as a destination is appealing at first look. Our policy environment is pretty progressive by global standards, and so it's attractive. The challenge we've got is, of course, the size of our market, and so we have to get over the minimum thresholds needed to attract foreign capital in any structure that is appealing. And that's something we're doing right now. So we've got, as I mentioned, we've got a product that's about to come to market, and we are talking to actually global investors about participation in that. So having those very discussions now, and I think that our policy environment and credentials do play well, but ask me in a few months when we're done. I guess, Barry, is probably the real answer, because that's the litmus test.
Yeah, good luck. Is there any issue with regard to New Zealand's regulatory environment being different, perhaps not so developed as particularly the EU's environment? The EU now has its taxonomy that divides the world into kind of sustainable and not sustainable, and they've got a couple of articles talking about green and deep green, Article 8 and 9. Are they likely to be barriers if we don't have that regulatory framework within New Zealand?
I think they'll become more and more important. I think the reality is now at present is that global investors really, have an appetite, but there's not enough supply of investable product. Absent green bond issuances, which isn't the right investment for everyone in their portfolio. So, I think what will happen as you have more competition, because there's more supply of investment opportunities, then those things are going to become more and more important outside of Europe. For us, it's a little bit different because our very mission is a qualifying one, if you will. It's an easier conversation because it's our very purpose to do those things. But when you're talking about being more removed from the investments and trying to see through both the manager and into the underlying assets, i.e. corporate equities, whatever else, that's where you start to really need taxonomies to play a bigger role. When you're closer to those investments and they're direct, you have other ways of getting that information as well.
Mm-hmm. In a small country, you know who the people are, and you know what they're investing in. Yeah. And Matt, for you, how does that global capital flow fit? Do you see New Zealand's kind of potential to be attracting global capital into climate action?
I mean, it definitely has potential. We've mentioned the regulations, the clean green image. So we've got an excellent brand with global investors, I think. That size is always going to be a challenge, though. The listed market cap is 170 billion, let's call it, and on the equity front. And there are funds in Europe that are many times the size of that. So, look, I think there's definitely opportunities, and specifically that sort of clean energy, I think is a good one, green energy, and I'd expect that would attract capital over time.
So I've just been to an event today for Tuatutahua, the Centre for Sustainable Finance, and they're obviously looking at a roadmap, a pathway for sustainable finance. Do you see things that need to be done from a government policy and regulatory perspective to actually provide more investable options to get the system working faster and at a higher scale than at present? The roadmap obviously came up with many things, but do you have particular priorities that you think should be accelerated in this process? Perhaps you first, Craig.
Well, I think the architecture, a lot of this changes has actually been put in place. It hasn't necessarily come into full effect, or it hasn't necessarily fully manifested in behaviors and in the market. But I think, the building blocks really have come to the fore in terms of, both the ETS, TCFD, all those things are actually going to have a material effect. And we're at the very beginning of those. And so, I think I made a comment earlier, which is eventually, you will have more investable opportunities, I think, in listed markets because of the reactions to those. So, you will see differentiation around companies from a strategy perspective. You will see aggregated assets coming in vehicles that, are more focused. You're going to see that manifest over time, would be my prediction. So those things are in place. I think when you start talking about further change, it gets very nuanced down to sectors, really. And so you think about, for example, the challenge we face around mass electrification. What does that mean with respect to how, the regulatory environment sits in that industry, not just with our gentailers, but how interests are aligned in, say, lines companies and distribution. You start to get very, very nuanced. And so I would say we're on a path, actually, but it just hasn't fully manifested.
Mm. And I guess we're going to see the emissions reduction plan very soon, which should help define that path a little bit more clearly. Yeah. Do you see those issues being an impediment, Matt? Do you see particular kind of priorities for things that would make a real difference in terms of low carbon investment?
I mean, on the policy front, I think there have been advancements that have made fund managers develop products, and so if you look at that default KiwiSaver review, the key change really from a sustainability perspective was getting rid of fossil fuels in those default funds. So that's while we wouldn't necessarily agree with exclusions all the time, there's no doubt that was a policy action, and it's led to new investable options that are participating in the change in the climate transition. So I think we have seen that. And we are, as I said earlier, there are more products in the market, today in New Zealand. It tends to be in the plain vanilla area of the market rather than the private assets currently, but I would expect that to change.
Mm. And many of those sort of plain vanilla end of the market start along the journey, as you described in your introduction, with a climate risk perspective and saying that we're aware of the risk of the climate to the companies that we invest in. Do you think there's a change happening in the investment sector where investment managers are also worried about the outcome side of it, their responsibility as investment managers towards reducing emissions, because they have a societal role and a societal responsibility? It's what is often called the business purpose argument by the head of BlackRock, Larry Fink, who writes annual letters calling for a sense of purpose to be applied to investment management. Do you see that developing in New Zealand, or do you see other fund managers being still very much on the minimizing risk perspective?
I mean, that's sort of the value versus values discussion. I think most fund managers that adopt this in their investment process are thinking of it from a value perspective. Some companies are going to be hurt by the transition to a low carbon economy. Some companies are going to do well, and so it's incumbent on them to assess those companies in that context. Ultimately, they're trying to make money for their investors, grow, provide better retirements and so on. And understanding how companies sort of work in a climate sense is just a key part of the investment process, I would say. Some will no doubt feel a sort of moral responsibility that as stewards of capital, they should do good and not invest in companies that are destroying the planet. But I think a lot of it is about from a value perspective, maximizing returns.
Mm.
Mm.
It is interesting that split that is really, I think, a time of transition. What do you think, Craig? You're obviously a little bit more on the side of creating impact through your investments rather than just managing risk.
I think your time of transition comment though really rings true to me. So I think, you will get a category of investments such as the ones we promote that are very, very climate focused. So the activity of the company is designed to have impact, right? But you also will get, and I think this is where, going back to my earlier comment, a lot of the policy design has already started, even though it hasn't played out in full. Companies who adapt to the opportunities that are presented in the newer, greener economy. So they will become more productive and efficient because they adopt new technologies and energies, or they will try to exploit those opportunities themselves as new product lines and initiatives. And so you're going to get, this manifesting in companies in different ways, where it's incorporated into their overall business. And I think this is where TCFD actually really plays. So they will have plans not only to mitigate risks, but they will turn those that thinking into creating opportunity. So it starts to get climate, because it cuts across all of us, including every actor, big or small, corporate or SME, will play a role. And so the analysis that's going to be required from the market around who's going to be a winner and a loser in that game will continue, even though it does it differently with this new thing called climate. While you were having that discussion, I was thinking a little bit more about one of the things that we could do. And this is kind of policy, if not indirect policy, but there's, we talk about mitigation, generally speaking, when we're talking about climate now, but adaptation, of course, is becoming increasingly important. And, a lot of the assets that are subject to that are not just owned by the private sector, but are owned by central and local government. And so, we have a tradition here of wanting to own those and financing those through mechanisms that exist, i.e., LGFA or, sovereign debt. There's a question as to the role the private market could play to accelerate activity in those things if those asset pools are opened up for investment. So, there are things that you could do at a very high level that could change the investable universe domestically that has a climate impact and focus. But going back to one of our earlier threads of discussion, they are big structural changes in the market here about how we operate.
Yeah. And certainly when we're talking about adaptation, the kind of changes that are going to be required in New Zealand across our society are huge, to all forms of infrastructure and to where you can grow wine, what you mean with an agricultural commodity when the climate is changing, etc. There's going to be huge changes. And I think, as you both said, those create opportunities as well as risks. And we're heading into a time when perhaps the brave will see the opportunities, and maybe those who are managing risk will just see it as a way to avoid things that might be a problem in future. Matt, do you we're probably wrapping up the seminar fairly soon. So by the way, for people who would like to ask a question, now's your last chance. But Matt, on this kind of opportunities, it obviously with a lot of the portfolios having a weighting for global equities and global bonds, it's less an issue about the New Zealand economy and more about how the global economy is looking at climate change. Do you how does Russell kind of see this as in terms of your global practice? Because we'd be mainly talking about the New Zealand context rather than Russell as a global institution. Russell's obviously done a lot of research on climate change. You have kind of different roles as an organization. What are you picking up from your international colleagues around the investment trends, about what's exciting, what's new? What can we be learning in New Zealand?
I guess the trends are that virtually all institutional investors are now thinking about this. As I said earlier, it does tend to be a process, and it does tend to take a while to get your hands around the issue. So understanding what you own, and the impact of those investments are having on the environment, that's sort of phase one, and we see that in most parts of the world now. Phase two, doing something about it. I mentioned, getting global equity or listed equity strategies, and tilting away from the high emitters towards the lower emitters. Engaging with your fund managers to make sure they're focused on this as well. And then what I'd call the leaders in this space are the institutional investors that are dealing with organizations such as Craig's, or climate funds, climate transition funds, and so on, who are really wanting to make an impact and are committing serious capital to that. So you do have the full gamut of responses. And it's interesting to watch. I definitely think the New Zealand investor base is not at the forefront, but certainly not at the rear either.
Yeah, interesting to see some of the debates and actions happening in the United States around this, where for example, many asset owners and trustees are still worried about whether they can invest in climate solutions because of fiduciary duty and so on, which tends to be less of an issue for European investors and New Zealand investors, I guess. Yeah. And Craig, sort of your conversations with your green investment banks internationally and with global investors, there's a question of so where does New Zealand, you referred a bit to New Zealand's clean green reputation previously, but do we have a kind of role to play in the investment field in a way that we do in other parts of climate policy? So perhaps leading on research on agricultural or dairy emissions, is there some aspect of investment practice that we can really be saying, well, New Zealand's got a position here globally?
It's a great question, Barry. And I would say we do. And in fact, it stems from just the different composition of our emissions profile. So, our peers globally are primarily focused on large scale renewable energy generation. And we're not. So, we're focused on everything else. So the things I've mentioned today, in part, so, transport, agriculture, etc. And so what you see is, as a focused investor in climate, is us crawling into those sectors faster than they are. And in fact, we just, for the Green Bank Network, which is a kind of our global peer organization, we just led our first knowledge sharing seminar on fleet electrification. So this is something, where in that universe, we're actually, at the forefront. And I think you'll continue to see that in those areas as we become more mature and do more. And that does include agriculture. That's, they are really looking for us to crack some of these problems from a climate perspective because they're focused elsewhere.
Yeah. And who do we look to? There's a question in the chat. Who do we look to as kind of international partners and international collaborators on these things? Typically Scandinavians tend to be somewhere at the head of the pack. I know on agricultural emissions, Netherlands and Denmark are doing considerable amount of research. Are they the kind of countries where we might be forging some common pathways?
Yes, but I think the answer is a little bit different depending on which part you're talking about. So the policy answer is probably a little bit different than the investment or finance answer, which might be a little bit different than the commercial answer as well. So for some things, the Scandinavian countries certainly fit the bill. For other areas, countries, although you could consider them Scandinavian, I guess Iceland, is doing some very, very interesting things because of its energy mix. In other aspects of the market, the US, because of how they securitize, as well as the availability of kind of, tax incentives to transition, they're doing some innovative things in the market. So there's no single answer to that. What I would say generally is that the green banks have been adopted, in those markets in the UK, as we know, which was a very early adopter, but in the US at the subnational level, so the state level, and we're starting to see them spring up. Japan has one, in various parts in Asia, and even we've got one in Africa now. So, it's everyone's learning and everyone's trying to do it at the same time, but all solving slightly different challenges.
Good. Just final quick last word from each of you. The challenge for the New Zealand economy to get to net zero is going to require a massive amount of capital, certainly far more than we've been talking about in this conversation. Are both of you optimistic that we're on that pathway, we're heading in that direction, or do we really need to be looking at something quite different in terms of meeting that challenge?
I have to say I'm optimistic. If I go back to the beginning of my career, investing for climate was sort of a silly small part of the industry. It wasn't something that was close to being mainstream. That was 25 years ago. If you think of how much has changed in that time, there will certainly be people who say we're not doing enough and we're not doing it fast enough. And, I think there's probably elements of truth to that. But we're making very good progress, and products to invest in the climate transition, they're becoming available. There's more routes to doing that for retail investors in New Zealand. We're focused on this. The CFIs are playing a leadership role, so I feel pretty optimistic that we're heading in the right direction. The question mark is whether it's at a fast enough pace.
Great. Final word?
Look, pace is the issue, right? And I too am optimistic. One of the privileges of my role is that I get to see all the up and coming technologies and companies, not just here, but abroad, who have solutions to these problems. And, as they grow and, their sales go through the roofs and we change our behaviors and everything else, that will have a change. And I think that rate of change is increasing. But pace is the issue. And I think, to the audience today, particularly for fund managers, what I would say is, think about your role in helping pace increase. A couple of things I mentioned earlier. One, how much money do you need in secondary markets? That's not new capital, and how your own mandates could be tweaked, if you will, to provide just a little bit more to primary and in direct investment and illiquid assets, because that will pay off, and not just for climate, but in terms of overall evolution of our market as well. And that's important for us. It's not just climate investors, but the market as a whole here could use some more development.
Cool. Absolutely. It's finishing on a slightly optimistic, but let's have some urgency kind of note. So thank you both very much. That was a really interesting discussion. I'm really grateful to you both, to Matt and Craig, for the discussion and your insights. I think it talks about the scale of the challenges, but also there are things happening that are really starting to change the picture. So thank you both. Thanks also to our sponsors for this series. We're sponsored by AMP, Booster, Generate KiwiSaver, Harvard Asset Management, and PwC. So we're gearing up for our exciting last 2 seminars in this series over the next 2 weeks. Please join us next week for an interesting seminar on investing in nature. We're going to welcome our panel with Simon Zadek, who's chair of the Global Organization Finance for Diversity, Gail Ogilvie, and Guy Williams from Australia. So please join us online then. That's Wednesday, 7:30 next week. And in the following week, we're going to be having a nice crunchy debate on investing in crypto. So if you've got strong views on that, please join us in a fortnight's time for that, which is going to be much more of a debate than our discussions from tonight. So thank you very much for joining us. See you online then. Ngā mihi nui kia koutou. Ka kite anō.
Thanks all. Thanks, Barry.
Thanks, Matt.
Thank
Thanks,
you.
Craig.
Good night.